Good afternoon. This is Drew Erickson back again talking about money, not math, because I love our country, but I believe our government is terrible at managing money and should not control our financial future. So my goal is to bring you value so that you can have more control of your money in the future and hopefully not lose unnecessary amounts of your money to taxes and other unnecessary things. So today I am talking about the difference between contributing to a Roth versus traditional 401k, IRA, or other, whatever else you want to call it, 403b, things like that. All right. And the big reason, I know it's March 10th today, so a lot of you have already filed your taxes, so I apologize if you wish you'd have known this information earlier. But for those who haven't filed yet and are still doing tax planning or are thinking about how you want to save for in 2020 for your taxes up in the next 9 months, hopefully this brings you value. For those of you listening to the podcast, I know it's a lot of numbers, so I'll try to be as clear as I can, but please, I recommend checking out the video if you want information or reach out to me. For those of you watching, I know it's not going to be the most exciting thing in the world to watch me read my own writing and go through an analytical example, but I hope it brings you value, and I really appreciate you taking the time to follow along. So I'm going to share my screen. Hopefully it works out for you to see it, and we will go from there. So you'll see that I started out by, I typed out, I didn't want you to have to suffer through me typing. So if I made any numerical, grammatical, or other errors, I apologize ahead of time. Feel free to reach out and correct me, and I'll try to be better in the future. But in this example, I'm not taking current tax rates and marginal tax rates into account because this is just supposed to be a simple example for everyone to follow along with. And let's be honest, we're in an election year. Taxes could very easily be changed next year. And hopefully this will bring people value even if they look back on it in 12, 13, 14 months. Who knows, right? So the point is, like I said, we're contributing, comparing contributing to Roth versus traditional 401k accounts. I think it's so important because so many people just show up to their first job or their new job. They automatically get registered to be in the traditional 401k, 403b, or other without even being asked, or if they are asked, it's a simple check the box. In many cases, you have to opt out if you don't want to contribute to your traditional accounts. So I think it's important for you to understand what your options are in the case that your employer does offer you Roth options, or in the case that you've taken the time, energy, and effort to work with a personal advisor and are thinking about what tools you want to utilize within your planning. So one key thing to know before I get into this, just in case I forget to get into it, if you contribute to your Roth 401k, Roth 403b, or other Roth employer-sponsored accounts, in every situation I've ever seen, which is not all of them, so it's possible I missed one here, or I'm a little bit wrong, the match your employer gives you is still contributed into traditional accounts and still tax-deferred basis. The reason for that, I believe, is because even though your employer is nice enough to provide a match, they're not so nice that they're going to pay the tax for you. They're still pushing that tax burden onto you to figure out later on in your life. All right? So just something to be aware of. If you contribute, because I know I've had people be like, well, I contribute 3% in my traditional and 3% in my Roth because I want a 50-50% split, just in case taxes do go down or they go up. But they're also getting a 3% match. So in reality, they have 6% of their income going to tax-deferred accounts, they're traditional, and 3% going to their after-tax Roth accounts. All right, so just be aware of that. Also be aware that if you contribute, let's say you make $100,000 of income and you contribute 10% to your traditional, that equals $10,000. We all agree. If you contribute 10% to your Roth account, that also equals $10,000. Many people believe that more money is going into the traditional compared to the Roth because of the tax consequences. That's not true. You just take home less in your paycheck because it's going to affect your taxable income. All right, so for more details or in-depth discussion on your personal situation, feel free to reach out to me if you don't have someone that you already trust that you work with. All right, so here's the example. Assuming you make $100,000 of income and you have a 25% effective income tax rate, meaning that's just the total tax rate on overall is the average, so $25,000. Saving 10% of your income or $10,000, growing at 5% per year, actual rate of return, meaning the same amount every year, it's not average, it's actual, for 30 years. Let's just keep it simple. So I already typed all this out, so I'm going to read through it for those of you listening to the podcast. In your traditional accounts, if you have $100,000 of income taxed at 25%, that's $25,000 of taxes owed. That leaves you $75,000 of net income. Now, if you're contributing to your traditional 401k, IRA, 403b, because that's just the default thing that you're signed up for you, or because maybe your CPA or tax accountant or tax person said, hey, if you contribute, you can get a tax write-off or lower your income tax. This is what happens. If you contribute $10,000 to your traditional 401k, IRA, 403b, etc., that lowers your taxable income to $90,000. All right, $100,000 of income minus $10,000 contributed lowers your taxable income to $90,000. All right, let's say your effective income tax rate stays at 25%, which I know there's variables involved that could change that, but let's just keep it simple. If 25% of $90,000 of taxable income means now you only owe the IRS $22,500 of taxes. All right, originally you owed $25,000. Now you only owe $22,500 of taxes. Congratulations, you saved $2,500 in taxes this year, which is what, again, to be clear, and oftentimes is your CPA's job. It's to save you taxes this year. I'm not saying they're wrong, they're right. I'm just saying that's the reality. You're saving money in taxes this year. But did you actually save money overall? All right, so let's look at this in a hypothetical future. $10,000 contributed to your traditional account growing at 5% actual rate of return each year for 30 years will grow to about $43,219 in 30 years. If your tax rate doesn't change at all between now and 30 years from now, so you're still at 25%, 25% of $43,219 is equal to $10,804.75. That's not okay. 75 cents. Already one error for me. All right, so I'm going to say that again because I fumbled through that. If your tax rate doesn't change at all between now and 30 years from now, and you still owe 25% effective income tax on your overall income, 25% of $43,219 is $10,804.75 owed to the IRS, leaving you $32,414.25 to spend. So you saved $2,500 in taxes the first year you contributed, but you owe $10,800 and almost $5 in retirement. Did you really save money? That's for you to decide. What if your tax rate goes up to 35%? 35% of $43,219 is now $15,126.65 owed to the IRS, leaving you only $28,092.35 for you to spend in retirement. Did you save money? What if your tax rate goes up to 45%? 45% of $43,219 is now equal to $20,348.55 owed to the IRS, and $22,870.45 left for you to spend in retirement. Did you save money? What if, instead of taxes going up, they go down? What if your tax rate goes down to 20% in retirement? 20% of $43,219 is $8,643.80 owed to the IRS, leaving you $34,575.20 for you to spend in retirement. Did you save money? All right, reminder, this person hypothetically saved $2,500 in taxes this year, but even if taxes went down to 20% in retirement, they still owed $8,643.80 to the IRS. So in your opinion, is trading $2,500 today worth owing $8,644 in 30 years when taxes go down? Or if taxes go up to 45%, is trading $2,500 today worth owing $20,349 in 30 years? Only you can decide that. I just want to make sure you're clear on your options. So now let's look at the other side of the coin. If you, I'm going to paste the rest of the story here because I didn't want there to be too much going on the screen. If you contribute to Roth or other after-tax accounts, $100,000 of income taxed at 25% equals $25,000 of taxes owed. We already established that, leaving you $75,000 of net income. If we contributed $10,000 to your Roth or other after-tax accounts, that does not lower your taxable income, and you still owe the same amount of income taxes. $10,000 growing at 5% actual rate of return each year for 30 years is equal to $43,219. If current tax laws don't change and your tax rate goes up, down, or stays the same, all $43,219 is still yours to spend in retirement however you want to, regardless of what the IRS and the government decide tax rates should be, as long as tax laws don't change. All right, as of today's tax laws, as far as my understanding goes. I'm not a CPA, just my understanding. All right, as we know, the government can change tax laws depending on who we vote into office. All right, so here's some things to consider if you're wondering, well, maybe I will or won't be in a higher tax rate, and you really haven't made up your mind. Well, some things to consider. One, is it your intention to receive raises and increase your income from now until you retire? Because if it is, that may push up your income tax rate. Two, is it your intention to continue living at a similar or better lifestyle in retirement as you were while you were working? Because if it is, your tax rates likely won't go down, depending on how you plan for your income, for your retirement. And also with that, who on earth works 35 years to decrease their lifestyle? I know my goal is to increase my lifestyle, or at least maintain, and probably go golfing a lot. Hang out with maybe potential future grandchildren or something. Three, and definitely travel. Three, do you believe it is more likely the government increases or decreases taxes knowing we are over $23 trillion in debt already? Or, and not to mention, neither political party is talking about decreasing spending. So somehow they're going to have to increase income. And the only way I'm aware they make income is off hardworking Americans who pay taxes. Four, do you believe your individual taxes will go up or down in the future based off this conversation and the knowledge that you have? Five, or before I say five, I forgot to add something in here. Are you aware, and I got to make sure I don't say this wrong, are you aware that as of today's tax laws, if you are single in retirement and you have $25,000 to $34,000 of taxable income, the IRS can double tax your Social Security, so tax it again, up to 50% of it again. If you're over $34,000, they can tax up to 85% of your Social Security again, because you pay tax on the way in. If you're married, did you know that if you have $32,000 to $44,000 of taxable income in retirement, they can tax your Social Security up to 50% of it again? And if you're over $44,000, they can tax up to 85% of it again. So knowing all that, do you think it is time that you start including efficient retirement income tax planning into your retirement plan? And if you don't already have someone you trust, maybe have a conversation. All right, so hopefully today's conversation brought you value. That's always my goal. I really appreciate you taking the time to follow along. Sorry for just kind of reading at you if that's not really your thing and you're more interested in visuals. Hopefully overall the concept is applicable and helpful for you. Please let me know what you think by reaching out. If you have feedback, I always appreciate it. And the best thing you could possibly do is share this conversation with a friend if you think they're going to find it valuable as well. Thanks again for your time. Hope you have a great rest of your day and great rest of your week. Thanks. Bye.